Most people lose money on their first crypto trade, not because the market outsmarted them, because they clicked buy before they understood what they were buying, how much to buy, or when to get out. In the next 9 minutes, I am going to fix that. You will learn exactly what you need to place your first trade, how to read a price chart from scratch, and the 5 rules that keep beginners in the game long enough to get good. I will show it on a real Ethereum chart with real prices, so you can see how this works in the wild. And pay attention to the 5th rule. It is the least exciting one. Almost nobody talks about it, and it quietly decides whether you are still trading in a year or quietly gone. No hype, no shortcuts, no course at the end. Let's start with the 3 things you actually need. 3 things: an account on an exchange, a small amount of money, and a plan for that money. That is the entire list. So, the exchange. An exchange is simply the marketplace. It is where buyers and sellers meet, and it quotes you a live price for every coin it lists. You put money in, you swap it for Bitcoin, Ethereum, or hundreds of other coins. And unlike the stock market, it never closes. 3 in the morning on a Sunday, the price is still moving. If you have not picked one yet, I have put my current recommendations in the description. There are a few worth knowing about. Some have the lowest fees, some let you start without uploading identity documents, and 1 or 2 let you trade crypto and traditional markets like stocks and indices from the same account. Pick the one that fits how you want to trade. Now, the money. Start smaller than feels serious. $100 is plenty. Your first few weeks are for learning the machine, not for getting rich, and every lesson is cheaper on a small account. Trust me, you want your expensive mistakes to happen while the numbers are tiny. And now, the single most important distinction in this video. There are 2 ways to trade on most exchanges: spot and futures. Spot means you buy the actual coin. You own it. If the price falls, you lose some value, but it can never go below 0 and you can never owe anybody money. Futures means you are borrowing money to make a bigger bet than your balance. It magnifies the wins and it magnifies the losses, and it can empty your account on a move that would barely dent a spot position. As a beginner, you trade spot. Only spot. We will come back to exactly why futures wipe people out. Open any coin on your exchange, and you will meet the same wall of green and red candles. Here is how to read one properly in about a minute. Each candle is a report card for one slice of time. The thick part in the middle is the body. It shows you where price started and where it finished in that slice. If the candle is green, price finished higher than it started. It opened at the bottom of the body and closed at the top. If the candle is red, price finished lower. Opened at the top, closed at the bottom. Then those thin lines sticking out of the top and bottom. Those are the wicks. And honestly, they are the interesting part. A wick shows you how far price stretched before it got pulled back. A long wick upward means buyers pushed and sellers slapped it back down. A long wick below means the opposite. Sellers pushed, buyers stepped in and defended. So every single candle is telling you 4 numbers: where price opened, where it closed, the highest it reached, and the lowest it fell. That is the whole language. Learn that. And the chart stops being decoration and starts being information. Now the slice of time is your choice. You set it in the corner of the chart. On the 1-hour chart, 1 candle is 1 hour of trading. On the 4-hour, 1 candle is 4 hours. On the daily, 1 candle is a full day of the world buying and selling. Beginners should live on the 4-hour and the daily. Here is why. The shorter the time frame, the more random noise you see, and the faster it punishes you for hesitating. The longer the time frame, the slower and clearer the story. Same market, completely different experience. And here is the part most beginners get wrong. They stare at the last candle and try to predict the next one. That is guessing. 1 candle on its own tells you almost nothing. The story only appears when you read a whole run of them together and see where price keeps stopping. So let me put a real chart on screen and show you exactly what a trader looks at. This is Ethereum, a real 4-hour chart, July 2026. And every candle here is 4 hours of genuine trading. Watch what I do first. Not the last candle, the levels. Look down at the bottom of the move. In mid-July, price fell to around 1750, and then it stopped falling. Buyers turned up. And from that point on, look at the dips. Each one stops higher than the one before it, around 1800, then around 1840. Higher lows stacking up like a staircase. That is what an uptrend actually looks like. Not a straight line up, a series of dips that keep refusing to go as low. Now watch this zone around 1850. Price came back down to it again and again and again, and every single time it held. When a level gets tested that many times and refuses to break, traders call it support. Think of it as a floor where buying interest lives. Now look up here, around 1950. Price pushed into it, got knocked back. Pushed again, knocked back again. That is resistance. A ceiling where sellers are waiting. And that is the entire chart in one sentence. An uptrend, climbing inside a floor at 1850 and a ceiling at 1950. That is it. If you can find one floor and one ceiling on a chart, you already understand more than most people who ever click buy. Because now you have something a guess can never give you. A place to buy, a place to take profit, and a price that proves you were wrong. Which brings us to the rules. Quick check before we go on. Look at this level. Price has dropped into it 3 separate times, and 3 separate times it has bounced straight back up. So what is that? Support or resistance? I will give you 5 seconds. It is support, a floor where buyers keep stepping in. If you got that right, you are already reading a chart better than you were 9 minutes ago. And that is the whole point of this next part, because knowing the level is useless if you get the next bit wrong. Rule 1. Only trade money you can genuinely afford to lose. Crypto can fall 30% in a week. It has done it many times, and it can do it again next week without warning you first. If losing that money would change your life, it does not belong on an exchange. Rule 2. Keep every position small. The common guideline is to risk no more than 1 or 2% of your account on any single idea. On a $100 account, that is a $1 or $2 loss when you are wrong. I know. That sounds painfully boring. Boring is the point. Boring is what keeps you at the table long enough to actually get good. Rule 3. Decide how you get out before you get in. Before you buy, write down 2 prices. The price where you take your profit and the price where you admit you were wrong and leave. And if price hits that second number, you go. You do not negotiate with a chart. The trader who moves their stop loss just this once is the trader who turns a small loss into a real one. Rule 4. Stay away from leverage for at least your first year. Remember futures. With 20 times leverage, a 5% move against you does not dent your account. It deletes it. And 5% in crypto is a quiet Tuesday. That is the whole story of most blown accounts. Not a bad analysis, just far too much size. And rule 5, the one I told you to wait for. Watch your fees. Every trade you place costs a small percentage. It looks like nothing. A fraction of a percent. Barely visible next to the price move you are watching. But it comes out on the way in and on the way out on every single trade forever, whether you win or lose. Trade a few times a week on a small account, and fees can quietly become the largest single cost you have, and the one you never notice, because it never shows up as a loss. It just shows up as an account that somehow never grows. So pick an exchange with genuinely low fees and trade a lot less often than you feel like trading. That is the 5th rule. Not exciting. Just the difference between learning to trade and slowly donating to the market. So here is your first trade, start to finish. Open an exchange account. Deposit an amount that would not hurt to lose. Stay on spot. Pull up the 4-hour chart and read it like we just did. Find the floor, find the ceiling, mark the trend. Write down your take profit and your get out price before you enter, not after. Size it so being wrong costs 1 or 2%. Then place it and let the plan do the work instead of your feelings. That is the process. That is genuinely all of it. And if you still need an exchange, my current recommendations are in the description, including the low fee ones, options that do not require identity documents, and a couple that let you trade crypto and traditional markets side by side. Nothing here is financial advice. This is education so that the market cannot surprise you on day one. If that was useful, subscribe. This channel takes one trading concept at a time and explains it properly with real charts and no hype. Next up, candlestick patterns. Now that you can read a single candle, the patterns are going to make a lot more sense, and you will start spotting them on your own charts within a day. See you in the next one.